The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on here to the Diagnostic Trading Hour. And checking out a few different things, seeing where the market's at right now, where everything's going on. And Diagnostic Trading Hour is where we talk about how to maximize leverage, minimize risk, and be one step ahead of the markets. So again, that's to maximize leverage, minimize risk, and be one step ahead. How do we do that? We do that over on the Nadex exchange. And on the Nadex exchange, you're able to go in and maximize your leverage by being able to put up a very small amount of money. Sometimes $10, $20, $30 to control, say, 10,000. And you minimize your risk because you cannot lose more than the money you put up to place the trade. And you can't get stopped out of the trade. So if the market goes against you, you're still in, but your risk doesn't increase, and you have until expiration to be right on the trade. So like say, 4.15 on an index. And let's go ahead and check out what else is going on, where the market's at. We got the S&P right now. I mean, everything's sort of, flat, not moving a whole lot. We got the S&P up 4 points. We got the NASDAQ down 5. We got the Dow up 16 and the Russell's up 3. Gold is down 27 points. Copper is down almost about 0.75% right there. We got silver moving on down almost 3% on the day right now. Corn down 8 points, which is over 1%. And we got soybeans down 22, 1.5% down right now. We got oil is flat on the day from yesterday's settlement price, just up a mere 4 cents. Natural gas moving like usual is up 2.4% right now on the day. We got the euro dollar is down a pip. So that's it. Yeah, that's right. 1 pip. We got pound dollar is down 63 pips. It has definitely been moving. And then we look on over, we got the Aussie dollar. It is literally up just a pip on the day. So, and then basically after retreating down, flew on back up there. And so we'll see where it ends up at. And then looking on over at the U.S. yen, it is up right now. 1.06 is actually up over 1%. So the yen keeps getting hammered with the dollar gaining strength on it. And let's see what else we have over here. Looking over, that's the U.S. yen. We got the U.S. franc. It is down a mere pip, pretty flat right there. And the U.S. Canadian is down 27 pips on the day right now. And so that's your quick market wrap, just to get you up to date on everything and how it's looking. And let's check out a few more things. We got, let's see here right now. I'm going to go ahead and pull this up. And we'll just look at the news that came out this morning and go over that. And stuff that came out last night as well. So in the evening, we really didn't have anything that came out. We did have, of course, the FOMC meeting minutes came out right after the show yesterday. And the market wasn't real excited about what they heard. We didn't expect a big move. We didn't get, necessarily a massive move on it, but it definitely did carry over into the metals and the currencies. We didn't get necessarily a massive move on the indices themselves. But looking on over and looking at that, what came out of that meeting was they saw that there was actually quite a bit of, instead of just one person, there's actually more hawkish votes and dissent as far as how long to keep the interest rate low. And they're wanting to, raise the interest rate. And a lot of people were saying at the end of 2013 or before the end of 2013. And so the market was not excited about that in the least. And that's actually what led to that little bit of a, sort of a mini sell-off that we had right there at the end before it bounced back. Overall, not a major moving event except for, like I said, in the metals, because if they're not going to keep QE going, then that would increase the value of the dollar and gold drops. Looking on over at what happened last night, we had that pound dollar. The PMI came out better than expected. And let me go ahead and open up a chart for you on that one. We'll look at it real quick. And let's take a quick look at the pound dollar. So we maximize over here. Here we go. And we can go and we can see when that report came out. It was released at 4:30, 3:30 Central Time. So we got it right here, and you can see how the drop started. And I mean, it really did move on down. It did a nice pullback, and then gave it back up, and is sort of flat on the day right now. We'll see where it goes by day's end. Looking on over at a couple other things, we can check out what other reports came out. We had the U.S. Canadian get released, and there was just an insane amount of reports. I warned you about this yesterday. I'm like, hey, go in and straddle the U.S. CAD. There's going to be so many reports coming out at the same time. And I want to say this was last week, we had the same thing. Like when all these reports are coming out, it's going to make the currency move. You don't know what direction it's going to move, so you want to do really more than a straddle. You can do a straddle on the spreads or a strangle on the binaries. So a straddle is where you basically are at like the floor and the ceiling of the same strike on a spread. And then on a strangle, it's where you're buying a higher binary and selling a lower binary. And we'll come back here in a minute to this and look at it. But you can see just a massive move. The employment change, the number came in much better than expected in Canada. And then employment change number for Canada basically is a simple measurement of the change in the number of employed people. They thought it'd be up 4,000. It was up 39,000, almost 40,000 right there for an improvement. The unemployment rate ticked down to 7.1% for Canada. So all that being very, very good for Canada. Basically, just, hence the drop in the U.S. Canadian. And our MPI came out a little worse, but not a major impact report. Neither was the IPPI. But still, all those reports coming out at the same time do have a definite impact on it itself. And then looking over here at the non-farm employment change number, that came in at 155, and that's the change in number of people expected basically employed during the previous month, excluding the farming industry. Okay, so again, came in at 155, and that is actually better than last month. It was 146. And we can go in, we can check out. Let's see here, just check out the S&P and what it did on that report. So we came out, report comes out. Now, again, a lot of other reports came out also. That report came out a little better than expectations, but there's a lot of stuff that goes into that report. But also the unemployment rate ticked up from 7.7 to 7.8. And so they got a mixed bag of news there with the good and the bad news. And so, like I said, a little bit better than expected, a little bit better than last month. But so basically, it went really crazy volatile right there. You got 4 or 5 points up and down. Very difficult to trade. Unless you're trading on something like Nadex, where you could have went in before or after the report, then a buy or a sell, and not have to worry about getting stocked out. And then once you go past that right there, we got the average hourly earnings. That actually did tick up a little bit from 0.2 to 0.3% for the average hourly earnings here in the U.S. And basically it's what it is. It's the change in the prices business pay for labor, including the farming industry. And it's a big indicator of consumer inflation as businesses are paying more for labor. And that, of course, is passed on to the consumer. And then back into business. So it just sort of cycles around, helps the money supply, supposedly, as long as there's more. The average, not necessarily the quantity. And then we got ISM non-manufacturing PMI. That came out at 10 a.m. So right here you can see not just a major impact on at least the indices. They did rise up a little bit on that number. It was a positive number. And we got a couple points, I guess, about 3-4 point rise there. And sort of flattening out. But today the number came in at 56.1 versus 54.2. And ISM is Institute for Supply Management. So the number, of course, is released on the website of the ISM, ism.ws. And you can, of course, hop over to their website. You can read the details of that report if you so desire to do so. I usually don't look at too many details on too many reports. I'm more watching the charts, but I do want to be aware of when they come out. That's part of that being one step ahead of the markets. When are major government news announcements coming out so I can be prepared, I can tighten stops, I can get out of trades, I can take positions, whatever I want to do, but I want to be aware of that. And like I said, that number came in better than expected, and what they do is they go and they survey 400 purchasing managers, they ask them questions about business conditions, employment, production, orders, prices, deliveries, inventories, so all sorts of stuff, and they rate their responses. And that actually not only was 56.1 better than expected, but it's actually the best number we've had since, let's see, March of 2012. So it's the highest reading since March 2012. And so a very, very high number. And then, of course, we look at last year's, ISM came out at 52. So it beat last year, it beat last month, and again, it's the highest number we've seen in multiple months. So that was a very positive report for the United States. I mean, it's not necessarily one that's going to just, make everything fly, but it definitely does help lift the market. And looking on over, and that unemployment rate, by the way, is a sort of an interesting dynamic going on in the unemployment rate. The Fed said, hey, we will keep interest rates low until unemployment gets down to 6.5. So it's sort of odd. When unemployment's bad, okay, in some ways that's good because that means interest rates stay low longer. So a negative report on unemployment could actually be a good thing. A positive rate on unemployment could actually be a bad thing. in the sense, and I'm not saying like, is good or is bad, but I mean, it could be viewed as good, and therefore the market could rise on a bad number because they're like, hey, that means unemployment stays longer. If also that thing ticks down to 7, people are going to be afraid interest rates are going to rise really soon, and that could actually cause the market to drop on a better unemployment number. So they just added a whole new fun mix to trading, and which direction is something going to go when it's good and bad, because it actually could be opposite based on interest rates. So take a little bit to wrap your mind around that one. And then looking on over here, checking out a few more things. What we got? We got factory orders. They came out at 10 a.m. They came in flat at 0. They were expected to be at 0.3. That's one of the lower numbers that we've had, but not the lowest number, definitely. But lower than last month. And then let's see, if we look at last year, same report, a little bit better than last year, definitely lower than last month, and lower than expectations. So that was not a positive thing. Hence, that helped stunt the impact of the ISM, even though the ISM was definitely it's considered a much more impactful report. Also, we had the natural gas report come out, and again, natural gas, talked about that yesterday. Natural gas coming out along with oil inventories. Let me get rid of this on here. My daughter was learning about Fibonacci levels last night. Let's see here. She's fun, but she's now 6. She's placed her first trades on the S&P E-minis, and she calls them the spoos. She uses a 4-trader vernacular, but when she was 2 years old. And so last night she was learning about Fibonacci levels. She thinks it's really fun to draw on the charts. But anyways, going over here, check it out, natural gas. So with natural gas right here, the report came in at 135 billion, or 135 British thermal units, and they expect negative 135, meaning inventories lowered. They thought it'd be negative 129, so not only was it less than last week, meaning the inventories are smaller, less than expected. And then looking at this time last year, we go down. We have to go through a lot of reports to get to last year. Let's see here. This time last year, this was the January, 4th report. So January 4th report, it is also lower than last year. So lower than last year, lower than expectations, and lower than last week. So in all cases, natural gas inventories dropping in basically all measurements there. And as you can see, inventory down, natural gas up. So less supply, more demand, boom, pops. So that's just a solid straddle trade right there, or strangle trade, either one. And then we also got crude oil. So on crude oil right here, we go into this, and we check out crude oil inventory report. Came out 30 minutes later, came out at 11 a.m. And if you look at the chart, see if you can figure out where it came out. Yeah, it's sort of weird. It didn't move a whole lot right on the report. But nevertheless, you did have an advantage. Actually, it's great when it takes this long to move off the report. Okay? So this report comes out at 11 o'clock, 10 o'clock right here. We get, these moves, and 11 o'clock, an hour later, the market actually started responding, which is sort of weird. But right here at 10 a.m. Central, 11 a.m., we got, decent little move, but it finally decided to move along with the report in an upside move. And the report right here was negative 11 million barrels there in inventory, meaning it dropped. And we'll go ahead and cover a little bit more detail about this and ways that you could trade it when we come right back from this break.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, welcome on back here to the Diagnostic Trading Hour. Checking out where everything's at on the market and looking over at all the deviations next. So now let's go ahead and take a quick dive into the deviations. And then we'll talk about some upcoming reports. Or, you know what, we'll go ahead and just talk about the upcoming reports right now, and then we'll come back to the deviations. All right, so we wrapped up today and got all that taken care of. Let's go ahead and look at what we got on the docket for tomorrow. Nothing. It's Saturday, but there is a FOMC member actually speaking. And he's moderating a panel. And the discussion is going to be called After the Crisis, What Did We Learn, and What Should We Teach About Monetary Policy? So, anyways, could be interesting. You can actually check that out over on the Fed's website. They release all their different speeches and everything. And that's federalreserve.gov. So if you want to look at what they have to say, then that's one way to do it. But you can check out their speeches right there. And, sometimes you do learn something and, get your mind in there. And they're obviously heads of Feds for some reason or another. And then monetary base coming out from yen on Sunday evening, but not a major impact report. Not expecting that to be a big driving factor. Then we walk on into Monday. I want to make sure you're set and ready to go. The Swiss franc is going to have its foreign currency reserves. It is a high-impact report. There is no forecast on the number, but it does have an impact because it shows how much, what the total value of all the foreign currency reserves they have, and they hold it in the Swiss National Bank. And it gives an insight into the Swiss National Bank's current, basically, market operations, how actively they're defending the franc's exchange rate against the euro. And if we haven't looked at this before, it is definitely an interesting thing to check out. And I forgot to come back. We'll come back to that one here in a second. We'll do this one right here. And but euro, franc, And let's put on back in time to daily. And you can see how they have obviously defended their rate there at 1.2. And so this report gives insight into how actively they're continuing to defend it. And you can see the the mover and shaker and everything else that's been going on, but they will not let it drop below 1.2. So it will stay below there for very long. It may spike, but it's not going to stay below very long. And as soon as it hit that, they kicked everything into full gear. And some interesting little short scalping trading opportunities if it gets back down to that level. And the euro getting hammered, if it keeps getting hammered, then it could bring it on back down there, and they'd have to kick back in, start doing a lot of trading. So anyways, that gives you some opportunities for some U.S. franc trades, or this is euro franc, but you can trade the U.S. franc based on that report. And then going in and looking at, let's see, a couple other things we got going on. The Halifax HPI, basically that's the price of homes financed there in Germany, and so it goes, basically it's an index of that, and it's for the Bank of Scotland. So, but it affects the pound. All right, the housing price index for the Halifax Bank of Scotland, the HBOS, is who's financing those homes. And so that's a medium impact report on the pound at 3 a.m. So you'll be aware of that one. Next big report is going to be on Monday morning at 10 a.m. Eastern Time. It's the Ivy PMI out of Canada. And the Richard Ivy School of Business releases that report, and you can check that out once it comes out over on their website, ivypmi.uwo.ca. And that's ivypmi.uwo.ca. And looking at that report right there, basically the expectations will come at 51.3. Anything above 50 is considered good, but of course they want to meet or beat expectations. Last time it came in at 47.5. So something definitely to be aware of. It's a leading indicator of the economy's health, and businesses basically react to market conditions. And so when they go through and they survey 175 purchasing managers on this, then that basically what that does is they go in by geography and sector and activity, and they match the economy as a whole to ask them to, just like all the other PMIs, how do they rate business conditions, prices, deliveries, inventories, production, things like that. So anyways, that's definitely a U.S.-Canadian possible moving event right there that you can take advantage of. And then looking on over at trade balance in the Aussie. So finally going to start getting some Aussie trades again. Aussie trade balance 730. And that number will come in negative 221 is the expectation. So 2.21 billion. And it came in at negative 2.09 last time. It came in a little bit better than that before. So we'll have to just basically see sort of what's going on there. But what it is the trade balance is the export demand of the currency. So that'll basically be important because it affects the nation's exports. So export demand impacts the production, the prices, domestic manufacturers, so all that. But it's basically the difference between imported and exported goods. So they have a net positive or negative. And looks like we got a caller on the line. We got Jim from Boca Raton. Man, how you doing out there in Florida, Jim?
Okay.
Great.
XCL, I have the 74 puts on there.
All right, let me switch on over into that real quick. We'll pull it up and look at it. See what we got. Okay, so we got the XCL.
Yeah.
Oh, XEL. Sorry about that. All right, so you going for which put are you on? Oh, stay right there. We'll come back right after this break. What is the put though? I'll check it out.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, welcome on back here to the Diagnostic Trading Hour. Okay, I think we got that result. I was like, there is no 74 put strike on that, but we had XEL instead of XLE. All right.
Yeah, XLE.
So do you own the stock or you just short the put?
The put.
Okay. So basically right now you're just trying to figure out, should you hold on? What should you do? It's been rising up over the last couple of days. When did you sell it?
No, I bought 34 puts. And
you bought the 34 puts. I thought you said you sold them. Okay,
you bought the 34. Yeah, the 74. The 74.
Okay. So you bought 74 puts, basically seeing this resistance line, I guess, is what you're looking at mainly. Is that right?
Yeah, I bought them. I was in profit. I was up 1,000, but I thought it might go down to 67. And then after that jive news about the fiscal cliff, they'll take any kind of news. You know,
yeah, all of them rise together. Yep.
Anything to tell the lie. So as soon as they heard the fiscal cliff, was over, XLE jumped back up.
Yeah. Well, what were you able to buy it at? What month expiration?
I bought it March.
See about the March 74 put, and I guess you bought it probably about a week ago. About
2 weeks ago, I bought it for about $2 and I think $2.50, and it went up. I was up 1,000, but I thought it might go down to 67. The XLE.
Yeah, it was moving on down there. Yeah, you're definitely up. And now you're about pretty close to break even on the trade. You're down about 50 cents or so.
Yeah, now I don't think that it's going down to 67.
Yeah, I would not think it was going down to 67 at this point. I mean, you do have till March. But here's the one thing that if you were, depends on how much if you're actually willing to risk the whole premium or not. But the big thing that we do have is we're going to have some major volatility coming up. Okay, the new Congress is getting sworn in, and then they're going to have to go into the whole fiscal debate, and we still have the whole everything that was the issue that drove the market down last week still exists. It's just delayed by 2 months. The nice thing is you actually have that time because you used an option without increasing your risk past the initial investment.
Yeah,
so,
I'm going to hang on. I was up 1,000, but I guess I said, well, it's going to go to 67, but it didn't. And as soon as the senators come out talking all their crap, then this thing shot back up.
And basically, I mean, you need it, if you bought it around $2 and you needed to close around 72 or lower to break even. And that's definitely within a realistic, very easily realistic range. So, I mean, I can see where you'd be hesitant at the same time. And you may even see it shoot up really far over the next few weeks, so it could really move against you.
Yeah, how high you think?
Well, until they start getting into the real big debates, I mean, it could pop up to 77 again. So, I mean, it could really fly up there. But if it moves up to 77, let's see, you're going to be looking at buyback. Let's see, 74, so 5, 6, 7. Right now, that'd bring your value, wouldn't bring it down too far. It depends on how fast it happens.
Yeah.
But, 73, 72, 71.
If it has a pop down,
maybe about $1.30.
Get out.
Yeah, it'd be about $1.30 value at 77, depending upon exactly how much time it takes to get there, because you got your theta and everything factoring in. But at the same time, I could easily see it coming right back. I mean, I think we're going to drop right back down to at least where we were at on those Christmas lows, the Christmas week there.
Yeah.
I easily see us coming back down to there. At least, if not, I mean, I don't know how far down we're going to go. We'll just have to follow the markets and see. But I could easily see it hopping back down to that low price where you were up $1,000. You won't be up 1,000 then because you'll have less time decay at that point, or less theta built in. But you'll also have increased implied volatility, which will help add a little bit of premium into it. So I mean, it's one of those plays. If you're willing to risk the $2, then it's not a horrible play because we know there's going to be volatility in the next couple of months, and you have at least until the third, the Friday before the third Saturday in March to be right on the trade. So that's right when all this stuff is going to be coming to a head, and so implied volatility is going to go up, which will increase the value of a bought option. And then, of course, the market is going to have to sell off as they're not agreeing and everything, but it's going to pop up and pop down a lot. So it's one of those things. Is it worth? And here's what you have to ask yourself: is it worth tying up the money over the next 2 or 3 months? Would you rather just take the hit and look for a better trade right now? So will the trade probably be profitable?
I'd rather wait. I got the patience to wait all these liars out,
So I think no matter what happens, we're gonna see the market come back down. Now they'll solve. I'm sure they'll solve something at literally the midnight 2 a.m. in this case, right?
Yeah. Same thing with Netflix. I got puts on that too, and it shot all the way up again.
Yeah, they got some new contracts and stuff that came out that helped them out too. But I mean, everything went up. So I mean, every single sector rose. It was a market-wide broad index in every way. The market rising, but it rose on nothing. So taxes went up on 70% of Americans, and I know they say we kept it low. I mean, at the end of the day, it went up on 70% of Americans. If you look at the actual taxes, and they solved nothing. The debt crisis still exists. The whole fiscal crisis exists. We have an issue with the debt ceiling, and Obama doesn't want to fight about it, and the Republicans are going to, they just got hosed. And they're going to fight probably 10 times as hard. We'll see what this new Congress does, but
we're all, and they lie. We're all still going to pay higher taxes, all of us.
Exactly. I said 70% of people are paying not even based on the increase. So, that's the whole all the other things that got cut out. I mean, there's anywhere from $60 or more on most people's paychecks are now gone on every paycheck. So I mean,
I don't know how these guys, market makers, could just take this kind of news and shoot the market up.
Well, it's good because it means for 2 more months, and we don't have to deal with it.
Oh boy!
And, I mean, it's sort of buy on the rumor, sell on the news, almost, but it's sort of in reverse. But this is sort of the news that just happens is more rumor. Hey, we're working towards a solution, And but I mean, yeah, it's just you just got at the end of the day, you just have to follow the charts, and definitely keep your tighten your stops up and everything else, and that's hard to do because you want to make sure you maximize those profits, but. If you're up $1,000, I mean, I'm not quite sure exactly how many you had on, but were you up to about $3 or $4 in value, or maybe?
I was up to almost $4 in value, up to 1,110.
Yeah, so you one of the best rules is, of course, at double take off half.
You're right. I said, well, it looks like it is going to 67.
Yeah.
But it never made it.
And I mean, that's right at a fib level and everything else too. So I mean, you're on target with where it could go. What you do want to do, though, when you're doing that target price is check out your charts, okay, where you think it may go. And then look at it's hard to see because the volume on here is just, it's just like...
I got it written down. I was at...
There we go.
The put was at $5.70, and I was up $1,110, and it was at $69.60.
So, okay, yeah, so what I would be looking at on this chart, what I can notice right away, is see the highest volume bar we have right here?
Yeah.
Okay, so I'd be going up to that bar, and since it was an up day, I'd actually be looking at the high price to be the magnet price. So, of where it's going to be drawn to.
Right.
And so we go over here, and basically right here, it'll draw the line for me, I'll zoom back in.
Mm-hmm.
So we got our high magnet price right here. So I'd actually be looking more for which is right in line with the fib level too. So right at like 69.20 would really be what I'd be focusing on, because that's our high volume bar. And again,
right, that's where it was
down day,
when I was
the low, but it's an up day. So yeah, 69.20 or so, 69 would be my first target, and it almost got there, and then it turned right back around. So,
oh man, it got to 69.60. That's where I had the highest profit.
So, and then something else, we talked about the future, and hindsight's always, always looks nice. Yeah, exactly. But, one of the things is whenever you are in profit and this is sort of like when I talk about diagnostic trading, like being one step ahead.
Yeah.
When major news is coming out, okay, such as, the whole fiscal cliff thing, and they're trying to work out a deal, and every 5 minutes it's we're going to do it, we're not going to do it.
Yeah.
If you're up on a position.
Yeah.
Take some off. Take enough off to at least eliminate your risk.
You're right. You're right.
The other half, that way it can ride, and if it makes a fortune, great, but then... You can go to bed at night. You can leave that thing on until March, and worst case, net, you didn't lose anything.
You're right.
And so, it's one of those things. I mean, it doesn't really help you now, but it is good to remember in the future. If let's say you're in the same position, okay?
Yeah.
And the thing's down at $69, and the vote's coming to the floor tomorrow, or whatever's going on. Then just use that whenever there's any kind of. And we knew that they were trying to resolve this thing before the year was over.
Right. So
when you know something in advance and you're up on a position, then you definitely want to take some off. And if you're down, you may even want to take some off, simply because if you're down on a position, that we don't lose all of it, but you have the chance to make it back if it does go ahead and move in your direction. And you had a sort of a 50-50 chance. There was a high probability they were going to pass something.
Yeah.
But, the whole country is like, what is really going to happen? Now I really don't know what's going to happen coming up. Everything says they're going to pass something, but now are the Republicans going to dig in? Or is the Tea Party going to dig in? Are they going to say, let's just take it? Let's just go to
the market doesn't care because they make up their own rules.
Exactly. So knowing that, write it down, enjoy it, take some profit off just in case they decide to go to, past the midnight hour. And you may make some extra, but definitely, just one of those things to, one of the things I like to do is make, I suggest every trader does, is keep a trading journal. And it sounds funny, like a diary or whatever, but...
Oh, no, I do.
Yeah, exactly, yeah. And then just write, the lessons, not only the trades you made, but the lessons you learned, And, because, if you can just grab one lesson a day, that's, a couple hundred lessons a year, and you become you just don't want to repeat your mistakes. I used to, whenever I was in college... I actually delivered pizza for Domino's. And I had this manager. He was a really cool guy. And but I remember him telling me, I was going around. He let me come in for like 2 hours in between classes. And that's all I did, work for like 2 hours a day. And he gave me all the big lunch deliveries and everything. And every once in a while I'd make a mistake or do something. Of course, like, anybody does. But he'd say, hey, Darrell, I don't care how many mistakes you make. Just make them once, And just learn not to repeat the mistakes. And that's just how trading is. You just learn and you grow, and we're constantly growing. And at the same time, our eyes, it's so easy to get very bogged into. I mean, I'm sure that's what's happened with you too. You're like, this thing's going to go. I'm going to make $3-4 grand on this thing. And it's so easy to forget that the goal in trading, and as weird as this sounds, the goal in trading is not to make money. The goal in trading is to trade well, and the net result is making money.
You're right. Not to get complacent.
Yeah, and you think about, like, let's just take football. The goal is not to win the Super Bowl. Yeah, that's the ultimate end achievement goal that's at the back of everybody's minds. But nobody can win the Super Bowl by trying to win the Super Bowl. They can only win the Super Bowl by one play at a time, which is gain a few yards, keep the other team from getting yards, and get enough yards on each play to get first downs, get enough first downs to get touchdowns, and get enough touchdowns to win the game. And can keep doing that till you get to the playoffs, and it keeps going. But it's all done. It's one in inches and yards. It's not one.
Right, because what I'm trying to do is throw a Hail Mary pass. I'll stay till the end.
Exactly. And a team that does that, there's no football team you would ever bet on that all they did is threw Hail Mary passes all the time to see if they'd work to win the Super Bowl. That's
what I'm trying to do. That's why I'll stay till the end, and I just throw it.
So, but just go in and just remember your goal is to trade well, not to make money. So always make your decisions, as hard as this is. I know it's easily said, not easily done, but make your decisions based on trading well. Don't make them based on your P&L. And say if I was a trader right now, and this is one way to look at it. Let's say you're over here and you can't see this part of the chart right here. And you're right here on this day, and you're up $1,000, and somebody else came in and said, "Man, that's a good trade. Should I go short?" Would you really suggest they get in right now knowing what's coming out the next day? And in the next couple of days, the debate that's coming up, well, it's like, yeah, you definitely could get in. You might want to straddle it, because, it could go either way. Well, if you say, well, you might want to straddle, you might want to buy a call and a put, because this thing could fly up or down based on the news that comes out. That's your clue to either, one, put on a call, or, or two, take some of your profit, or three, get out. Yeah, so one of those.
Makes a lot of sense in the fact that write the mistakes down and write the things that you're not to do anymore,
Yeah, and at the same time, write down the things you do correctly, because you want to repeat those as often as possible.
Yeah.
So it's like you want to learn what you did well and repeat it as much as possible, learn what you could have done better. And, it's not about beating yourself up. It's about learning. It's like, hey, as long as you learn something, great. And some days you make a trade, it doesn't go well, and you did nothing wrong. You traded well. It just didn't work out, and that's okay. And it's important to know the difference. That way you're like, there's really nothing to be learned today, except for I stuck to my rules. Sometimes they work, sometimes they don't. But, I don't want to, what I don't want to do is make mistakes and they do work. Because here's what's dangerous. You go in, you do that trade, you're up $1,000. You hold on to it. Okay. And this sounds funny, but this is one of the worst things that happens in trading is, let's say you're right. The thing just plummets down to like 63 or something. Okay.
Yeah.
And you make a lot of money. Should you have done that? It's great that you made the money, but should you have not taken some off? Should you have not put a call on? So you don't want to. You want to make sure you're learning. Like, hey, you know what? Even when I won, even when I profited on the trade, is there something? And it's hard to question yourself when you make money.
Yeah.
But is there something that would have been a little wiser for me to have done?
Yeah, you're right, yeah.
Because otherwise what happens is you're rewarding yourself for your mistakes, and then they burn you in the end, because then you go and you throw even more money on the next one, and that's the one that does lose, because it didn't go to 63, it went up to 78 or whatever. So,
yeah, sir.
But anyways, thanks for calling in. I hope I helped you out, gave you some ideas, and I think you got some volatility coming your way.
Okay, thank you. Bye-bye.
You bet. Bye.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome on here to the Diagnostic Trading Hour. Let's go ahead and check out a few more things real quick. One of the things we talked about with the U.S. franc, we're also looking at oil. And let me pull that oil chart back up. And a little bit earlier, about oil, we had that inventory report that basically said oil should rise. It did rise, then it fell, then it rose again. And so whenever you see an oil inventory report where the supply is lower, you should expect the rise. The rise does happen, then it pulls back. This can give you a second entry point to check out. And so this is something to think about. It's something you can get back in there. Now, would I buy on an oil future when it's falling like this? No, because you can get hammered on that trade. So it fell from 92.77 down to 92.20 or so right down here. And so you're talking $500 on a single contract. But when I'm going to buy an oil spread, an oil binary, yeah, I would expect it to, at least if it falls down, bounce back to the strike price right where it was at before the inventory report came out. It definitely did, pulled back up. It gives you a pretty sweet trade that you can take advantage of. And then one thing is also checking out the deviation levels and looking over at where the deviations are over on oil. And looking at oil, we had an expectation that it moved down to 92.17, and it didn't even quite hit it. It came pretty low, and you can look back at the overnight. We easily hit it in the overnight session. We actually went all the way down to 91. It's like 52 as our low price, which would have been just a few ticks shy of a full deviation retracement. And so to expect it to go back up to settlement 92.22 or higher, easy. It goes ahead and moves back up. But again, when it pulls down and it's moving towards that deviation, if you want to go back and buy back in, that's a good way to buy back in, because you have a positive fundamental report helping drive the price of oil. And then, of course, natural gas, we had the report come out. It shot up, actually gave you a pullback with another entry. And I've seen this a lot lately. It's been sort of interesting on the energy reports, where it'll shoot in the direction, it'll pull back, and then it'll go back in that direction. Basically gives you two entries. And sometimes the second entry, even though lower volume, can sometimes actually be a better entry, because you can just pick one direction versus doing a straddle or a strangle on it. And so it shoots up, it pulls back to where it was right before that report came out. You go in, okay, well, what was the high that it hit on that report? We got a high of 3.293, so you could actually go in for like a 3.293 strike. And you could even go over and cross-reference that, which is above a one deviation level in itself. So, anyways, but you expect it to go back up to that high of that strike of where it shot to over it, and so it goes back up. Or you could go, it didn't drop that far down, but it did at least drop back down to the original price, and that's what we're talking about over on CL right here. If we go in, shoots up, it comes down, you can do another buy expecting to get back to the high. And then when it drops down again, you could expect it to go back to the high too. So you had like literally one entry here, and then one down at one of the deviation levels, you could have got in again. But just think about that when you're looking at energy reports. And I'm not saying hop in with live money. I mean, check it out with a demo account, trade it, test it, get down a system. But when you put it all together, it is pretty cool how you can sometimes actually get in after the report when it gives you that pullback. It doesn't always give you that pullback. Sometimes it'll just take off. But when it gives you that pullback, that can really make for a great entry to hop in and actually have a price level, which again being the high based off the report. And you notice how it went up, it spiked that high, and then it fell back. So I'd be getting out right when it got back up to that high. And again, same thing on natural gas. Spikes up, pulls back down. I mean, I probably would have got in here, not over here, just when it came back down to the entry price. But when it got back up to this price level, get out, okay, of your position. And notice how it started to retreat right when it hit that level again. So it's just one of the many different ways to trade the energy reports. And they come out every week, so you actually get quite a few chances to do it. And you can even go back and pull the history of the energy reports. You can look at them and see how was the price action, how did it move, on what date, and so you can start to sort of analyze the pattern of that report. Does it give you a whole lot of pullback entries, or are you better with the straddle or strangle? The pullback entries, to me, are some of my favorite ones. They're a little bit more nerve-wracking because you're going in the opposite direction, but at least you're going with the fundamental report after it does the pullback. Anyways, hope we got you some new ideas today. We had some fun talking about trading psychology. And I will see you on Monday. Everybody have a great weekend, and stay tuned. We have more great shows coming up for you.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.